Hello, everyone, and welcome back. US crude has dropped over 38% from its highs this year. But will prices return to pre war levels? Let's check the technicals. On the daily chart, we highlighted before the triangle formation. Now, the major bearish technical signal came on May 25th. Price broke below the triangle. The breakdown confirmed, but here's what makes it clean. In early June, price came back to retest the underside of that broken triangle. Exactly what technical analysis would expect. And it failed. Sellers stepped back in immediately, and that retest and rejection is what gives this move credibility. And we've seen the prices dropping to the expected levels. Now, if we zoom in, we're now tracking inside a well-defined descending channel. Lower highs, lower lows, both boundaries respected. Price is currently around $73.5, with $75 as the immediate resistance and $70 as the next key level below. One thing to watch, RSI is approaching oversold. That doesn't change the trend, but it does mean short-term bounces are possible. In a downtrend, those bounces are where bears look for possible entries, for example. Now, if we go back to the bigger picture, before this conflict, crude spent nearly a full year ranging between $66 to $55. That was the market's equilibrium, before the geopolitical shock broke it violently higher. Now, with the supply chain reopening, those levels become the gravitational pull. Goldman Sachs estimates flows may recover to only 70% of pre war levels initially, and the current deal is happening through phases. So the path back to those levels won't be straight, but they're on the map. $75 is the resistance to watch, $70 is the battleground, and $66 to $55 is where this market came from.